Hey guys, this is Patrick with Financial Grit Media. If this is your first time watching any one of our videos, make sure you press the subscribe button and turn on those notifications. That way you are alerted every time we load another video to this channel. Now in today's knowledge video, we're going to be talking about stocks. And specifically, we're going to talk about what are stocks. For those of you that don't know what stocks are or have a general idea of what stocks are, but not particularly understanding why stocks are out there. Now, we've been covering stocks a lot in our channel, and so I wanted to make sure that you knew what stocks are before we go any further in this channel. So what are stocks? Well, the definition that I wrote down here was a stock gives the holder partial ownership of the company they hold the stock in. The amount of the ownership is based on the number of shares you hold versus the amount of shares outstanding. So basically, when you own a share of a company, we call that a stock. If you own a share of that company, you have ownership rights to that company. Now, the number or the percentage of ownership rights you have is based on the number of shares that you own. So for instance, Apple has 908 million shares outstanding. And so if you owned one share of outstanding Apple stock, you would be 1/908 millionth of an owner of Apple. So you notice how when you own one share, you really don't own a ton of the company, but you own a very small portion of that company. So another way to think about this is if Apple has 908 million shares outstanding out and about throughout the world, you would need to own 90.8 million shares to own 10% of Apple. Now, right now, as of the close of business on the date that we're recording this, Apple shares were about $175 a share, which also means that if you wanted to buy 10% of Apple, which would equate to 90.8 million shares, you would have to pay or buy $15.9 billion worth of Apple shares. But if you did that, you would own 10% of Apple. So the big question here is, why do companies issue shares, and why are you allowed to buy shares of their company? Well, it comes down to resources for a company. A company needs to bring in resources so that they can grow and expand. Now, they can do it in three ways. Way number one is they can produce more revenues and produce more gains or net income at the end of the year, take those profits, reinvest it into their company. Now, that's easier said than done for a lot of small companies. For a lot of big companies like Apple, they could technically do that because they have billions and billions of dollars sitting on the sideline that they can use to reinvest in their company. And so one of the biggest ways a company can reinvest into themselves, become bigger, grow, innovate, is to make more money. Again, that's easier said than done for a lot of small companies. The second way they can do this is they can take out a loan from a bank, or they can issue debt. Now, the problem with issuing debt or going to the bank and getting a loan is that you're going to have to repay it back with interest. And so it is an option for a lot of small businesses. However, it may not be the answer for a lot of small businesses that don't have income, net income. They're at a consistent loss. So that's one other way that that a company can acquire more resources so they can innovate, they can make more money, they can grow within their organization. The last big one is to issue shares of stock. Now, the way that I think of it is they're giving up ownership in their organization, or they're giving up future profit rights to their organization in return for cash now through the sale of their stock. And so companies find this vehicle as an option where they can take their ownership, the owners can take the ownership and sell it out to the public in what we call an IPO, initial public offering. So let me give you an example. Let's say a company wanted to raise $10 million, okay? And let's just say that they're going to issue 1 million shares. Now, I haven't really told you what 1 million shares would be like, but if they wanted to, they had 1 million shares that they were going to issue out to the public, and let's say they can get $10 a share for their million shares. Well, on their IPO date, they would price their shares at $10 a share. They have a million shares. A million times 10 is $10 million. So they're giving up a percentage of their company for $10 million. That $10 million they get to keep, minus all the fees and associated transactions with issuing the stock, but they now have $10 million where then they can reinvest and grow and make their company bigger. So the reason why companies issue stock is so that they can bring in resources, in this case cash, so they can grow, expand, and make more money at the end of the day. Now, we talked about this 1 million shares. How much is that worth of a company? Well, that depends on what the company is authorized to issue. So let's say that this company had 10 million shares outstanding within their owners, okay, private owners, and they decided to come together, give up 100,000 apiece, and so that's 1 million shares, and so that 1 million shares represents 10% of what's already held within the ownership group. Okay, so again, what does one share mean? Well, one share means one share ownership is different based on how many shares are outstanding. For Apple, it's 1/908 millionth of an ownership. For a company that I just spoke about, it's 1/10 millionth shares. Okay, so that's why companies issue shares. Now, companies don't make money after they issue the shares per se. So when they issue their shares in an initial public offering out to the public can now buy it for $10 a share. Now, the way that the company then does not make any money from that share ever again because that share is out of their hands. The only real way they can make money is to buy back those shares, and then they wouldn't have to pay dividends on those shares per se, okay? Now, the way that you as an investor makes money from owning that shares is twofold. Fold number one is if the company pays a dividend, you're gonna make money in that dividend. Number two, the way that you can make money is if the price of that share goes up. Now, what would make the price of the share go up? Well, what would make the price of the share go up is based on supply and demand. Let's say the company is doing really well. Well, other investors might see that and go, hey, I really want to own this company because they're doing well. Well, if you have some shares, you don't want to just give it away, so you're going to ask for a higher price, let's say $20 a share. And they're willing to buy it for $20 a share because the company is doing really well. Well, when you sell it for $20, you would make $10 because you would have bought it for $10. So 20 minus 10 gives you $10 of profit. So the way investors make money is through the appreciation of the stock price as well as the dividend that the company may pay. Now, what are dividends? Dividends is a distribution of the profits of the organization to its shareholders. Now, before we get into any details with any dividends, because we'll save that for another video, basically, a company may take some or all of their profits and distribute it to their shareholders. Now, again, it's very smart for a company not to distribute everything because they need that money to reinvest in their company. And if they're just distributing everything, they're not investing in their financial future. So that's a little bit about what stocks are. So stocks are partial ownership in a company. In exchange, the company gets cash for that stock issuance. And the reason why companies issue stock is because they want to bring in more resources so that they can grow, so that they can innovate, and so that they can make more money in the long term. So that's this video or knowledge video on what are stocks. Now, if you like this video, make sure you give it a thumbs up. Make sure you subscribe to this video and leave a comment in the comment section below if you have any questions or you're just wondering, hey, what are stocks? So with that, again, I'm Patrick with Financial Grit Media, and we'll see you in the next Financial Grit video.